Russ, have you increased the exposure to U.S. equities during this recent pullback? If so, which sectors?
We've been buying a little bit. We were trimming towards the end of August after that tremendous run. We've been trying to do in recent weeks is take the cyclical exposure up a little bit. So include things like the industrials, rails, manufacturing, not just in the U.S., but also in Europe. It's not that we think tech is going to roll over. We still like the themes. But on a sort of shorter-term tactical basis, we're comfortable with the economy. We think we're going to continue to see improvement, and we're looking for names that are levered to that improvement.
Why are you comfortable with the economy and expecting improvement in the cyclicals if we just don't know whether we're going to get more stimulus, which seems like a huge swing factor? And if we do get more stimulus, we don't know what size it's going to be. The Democrats are talking about a skinny bill now that's still in the $2 trillion. Republicans are nowhere near there.
Yeah, look, Sarah, I think it's a fair question. I mean, there's so much focus on the stimulus. I get it. That was meant to be the sort of the marginal boost for the market. But if we take a step back and remember how much stimulus we've already received, and you've really been able to plug a hole in household spending. The labor market has come back much faster than we thought. We're seeing manufacturing rebound, the housing market rebound. It's not that it's all clear. We're certainly not back to where we were in February. But even without that additional stimulus, we're benefiting from the low rate environment, from low inventories, and from households that came into this crisis in a much better shape than they were coming out of the GFC.
Steph, I know you've got quite a few of the cyclicals as well as we've been discussing in your barbell. What if we get no stimulus at all for the rest of 2020? Would you be worried about how those stocks would perform?
Well, they probably would underperform in the near term on a relative basis for sure. But I think to Russ's point, the amount of stimulus that's already in the system is really pretty significant. It's 44% of U.S. GDP if you add fiscal and monetary policies that have already been enacted, right? So that's a lot. That's a great tailwind. And yes, low interest rates for longer, forever, is actually also very positive. But I mean, look at the economic data, other than in jobs, right? The economic data has been really good. I mean, housing, 1 million SAR in new home sales. That's best in 14 years. That is a huge, huge number. The manufacturing market PMIs are comfortably above 50. Expansion. And the consumer, let's just throw out a few names. Lennar, RH, Herman Miller, Nike, AutoNation, AutoZone. All of these companies blew it away, right? So my point is that there are pockets in the economy that are not doing so well. I know it. That's why we need the stimulus. That's why I think you get it. But I think there's enough stimulus in the system to have some of these cyclicals do better, because I think the economic data is going to continue to get better, which should help profits down the road. And this sector and these groups, industrials, materials, discretionary, they have operating leverage.